Yeah, I think I said it was the most radical monetary policy relative to the circumstances in history. Look, I made a New Year's resolution that year not to be on TV, but when I saw what was going on, I couldn't control myself. I haven't been on TV since. Apparently this isn't on TV, that's a good thing. But I was just incredibly frustrated with what to me looked like a Fed that was just taking unbelievable risks. For what? The story at the time was inflation was 1.7, and we were buying 120 billion bonds a month. This was post-vaccine, successful vaccine, because inflation was 1.7 instead of 2. So we're taking this massive gamble where you threaten 40 years of credibility with inflation, and you're blowing up the wildest raging asset bubble I've ever seen. And I knew that the worst economies happen post-asset bubbles. The 30s here, post-89 in Japan, after the housing bubble blew up here. So that's what I went on. If you remember, the Fed did $2 trillion in QE after vaccine confirmation, and after the time I went on, you had the strongest momentum in employment in history on a rate of change basis. At the same time, their partner in crime, the administration, was doing more fiscal stimulus, again, post-vaccine, after it was clear emergency measures weren't needed, than we did in the entire great financial crisis. I'm not talking about before the vaccine, I'm talking about after. Look, it turned out I was right. I've been wrong plenty of times in my life. The Fed was wrong, they made a big mistake. It's not so much that they were wrong, I've been wrong a lot. It's the risk-reward bet they made. There's some news this morning in England. 30 years ago, we shorted the pound in the quantum fund. I didn't know whether the pound was going to devalue. What I did know was if they didn't devalue in the next 6 months, my fund was going to lose 50 basis points. If they did devalue, I was going to make 2,000 basis points. So it was a 40-to-1 one-way risk-reward bet. If you look at what the Fed did, the radical gamble they took to get inflation up 30 basis points from 1.7 to 2, it's to me sort of a risk-reward bet. You bet one to lose 40, and they lost. And who really lost? Poor people in the United States ravaged by inflation, the middle class, and my guess is the US economy for years to come because of the extent of the asset bubble in time and duration and breadth that went on.
So they have that dual mandate. So you think that in the back of Jay Powell's mind, he was like, I got 30 basis points to go to get where I want to go? Or was he just saying, I don't see a problem yet, I want full employment, so I'm going to let it ride at that point? Because the problem I have is that there's inflation and there's asset inflation. Was it not clear at that point that even if you weren't at 2%, there was asset inflation everywhere? Now, how does a guy that's running the Fed why is that not on his radar screen?
Because it's not part of their mandate, in their opinion, and I don't think they looked at it as a risk. And to be fair to him, we'd had 20 years of disinflation. People tend to live in the past, and he had plenty of company, including on your network. So the other thing I'll say is I've been wrong a lot in my career, and when I do, I correct my mistake. What was particularly mind-boggling to me, 2 to 3 months later, inflation takes off. It's no longer a theory. It's actually happening. We come up with this ridiculous theory of transitory. So we have $5 trillion in fiscal stimulus. We have $5 trillion in QE. Janet Yellen is running down the TGA account, so that's another $1 trillion in stimulus. And if you remember the monetary framework, in the fall of 2020, they were no longer going to forecast. They were going to be data dependent and wait till they see the whites of inflation's eyes. So guess what? They saw the whites of their eyes, and what did they do? They forecast that it was going to be transitory. When you make a mistake, you got to admit you're wrong and move on. That 9 or 10 months that they just sat there and bought 120 billion in bonds, I think the repercussions of that are going to be with us for a long, long time.
So they're going to were they partners in crime with fiscal spending as well? And is that what caused, I mean, inflation is everywhere. And we know about Putin price hike, and we know about supply chain issues following the reopening. But is it really the growth in the money supply and the deficit that is the root cause of what we're seeing right now?
That's what lit the match, absolutely. I mean, come on. When I'm on TV, I wouldn't consider this one of my better calls. You got massive fiscal stimulus, you have massive monetary stimulus, and the thing is already starting to percolate, and of course it's what caused it. What I will say, there's a lot of people out there saying, well, Putin caused it. Putin did extend it, all right? But can I remind everybody that when Putin invaded, the CPI was 7% year to year before he invaded, and all this crazy stuff we did was to get inflation from 1.7 to 2, and
Right.
we were already at 7. But yeah, once you light the match, and we found this out in the 70s, inflation rotates. That summer, everybody kept talking about used car prices are going to come down, this can come down. That's not the way it works. And by the way, there are a lot of disinflationary things happening now in the goods sectors. But so the UK unions, okay, do you think they're going to come in the spring and they're going to negotiate and they're going to say, oh, well, the five-year forward is 2.3, so yeah, I'll take a 2.3 raise.
Right.
No, it's like the railroad workers. They just got 24% over 3 years. When you lose that much purchasing power, so then the wage negotiations, it seeps in there. Then, of course, there's customers of companies that have to raise their wages, and the thing spirals. And that's what we're dealing with, and that's the position the Fed's got themselves in, with basically a boom-bust policy. But yeah, they were not alone. The fiscal stimulus was a huge part of this, but to be fair, they enabled it. The government can't spend $5 trillion if they don't print it.
Yeah. The move today from the Bank of England, the last I looked, I haven't looked, in this market you got to look every 2 minutes, but it was being received positively, which I thought was pretty shocking. I guess it was the notion that if they blink, maybe we blink sooner than people thought. I would have thought this is one of those, you mentioned 30 years ago, this is one of those things where they put a drop in the ocean trying to stop this thing from happening. And it's not going to work, probably. And it almost indicates maybe there are some underlying dislocations because rates have gone up so fast. Do we need to worry about what happened in England today? And are you surprised at the
I think it's a microcosm of everything we're talking about. We've had 30 trillion of QE globally over the last 10 years. When you have free money and you have bond buying for that period of time, it creates bad behavior. Okay, so the pension funds and the insurance companies there buying bonds, repoing, taking the repo money, levering that up with equities and all kinds of stuff to try and enhance their returns. And by the way, doing so when gilts are yielding what, 2.8, and inflation's 10 or 15? That doesn't happen if you don't have the environment created the last 10 years. So you're the Bank of England, and you've got this situation on your hands now, which is quite serious, because I think 30% of mortgages there are, or at least 30% are heading toward being variable rate. What do? Well, what you don't do is go and take taxpayer money and buy bonds at 4% when your inflation rate is over 10. You don't cure inflation with an inflationary act. And buying bonds, 7, 8, 9 points under the inflation rate, of course the markets are cheering it because, they got a Band-Aid, everybody's blinking. But this is creating long-term problems down the road. That 30 trillion has created all sorts of stuff that's probably under the hood. I used this term a week ago. I didn't even know about this thing happening. And you're going to see more of it because that's what happens during asset bubbles. Behavior changes.
Recently, you talked about the potential for a 1969 to 1982, potentially type situation for the next 10 years here in terms of the indexes being at the same level a decade from now.
Yeah, I will say this. It's conventional wisdom, which I agree with, that stocks go up over the long term. Okay. The problem is we've become a little complacent about what does long term mean. If you bought the Dow in 1929, you got back to even in 1954. As you just pointed out, the Dow was in 1966 where it was in 1982. When I look back at the secular bull market that started in 82, let's just take a trip down memory lane. We had a president who said government was the problem, not the solution. We had a guy who fired all the air traffic controllers in the country when they wanted a big raise. We now have a president who is a union man who says he's trying to beat inflation, who cheers a 24% over 3-year reward to the railroad unions. We have a president who thinks government is the solution, not the problem. Maybe more importantly, or I'd say in terms of what we're talking about, if you look at valuations back then, the S&P was 50%, the stock market was 50% of GDP. It's now 150 down from 225. That's because 5 years yielded 15% when I started Duquesne, so real rates were high. That's why we were at 8 times depressed earnings. We're now, 18, 19 times inflated earnings that I have a very strong feeling are going to be down next year. Then you had the secular forces. You were right on the initial ramp of globalization, a fantastic thing. Building supply chains around the world increases efficiency, causes disinflation. That's been a trend for 20 or 30 years. Going the other way now. We're disentangling all that. That's going to be inflationary. And then finally, and we've already kind of alluded to it, the last 10 years of the bull market, you put it all in hyperdrive with 30 trillion of QE and 0 rates. Now the consequences of that are born, and all those factors that cause that bull market, they're not only stopping, they're reversing. Every one of them. We're going from QE to QT, unless you live in England this week. They're really unfolding. So when I put all that together, the one thing I bristle a little bit when I hear people on your network is they say, well, I'm bearish, but I'm bullish for the long term. Look, you can have a period of 15, 20 years, 10 years where the market doesn't go anywhere. That doesn't mean you can't make money. You could have made money, plenty of money in the 70s at various times. We had 260% rallies. I'm not saying, go get another job and you can't do stocks. I'm just saying we've had a hurricane behind us for 30 or 40 years and it's reversing. And I wouldn't be surprised, in fact, it's my central forecast, the Dow won't be much higher in 10 years than it is today.
There was a time you went to college campuses and you talked about an equity and debt. I think in this case it wasn't necessarily Fed-induced, but it was entitlement-induced. Yeah. And it could come, this was 10 years ago, and I think you said sometime between, Nostradamus. You said 2020 and 2035.
Yeah.
So it's is it 2022? Is it happening?
We are in deep trouble. So everything I said at those colleges is worse in terms of the metrics, except for one thing. And what I miscalculated was I didn't calculate 0 rates, I used 4% rates. But the only thing Donald Trump and Hillary Clinton agreed on in 2016 was don't cut Social Security, don't cut entitlements. So nothing was done. Joe Biden has excoriated Rick Scott because he dared mention maybe we shouldn't be increasing senior pays. But if you look at the reversal I just talked about, and you use the CBO estimate, which is rates at 3.8%, which I think frankly is pretty optimistic, given all the things we've talked about. By 2027, the interest expense alone on the debt eats all healthcare spending. By 2047, it eats all discretionary spending. So we're now getting into fiscal dominance. By the way, by 49, it eats all Social Security. We're getting to the point now where the interest expense on the debt is so high that it's going to eat up our ability to basically service the next generation. I'm not even sure about the current one.
Okay.
I brought some cyanide if you'd like one.
No, I'm thinking about that, and I'm thinking maybe we'll be okay, but
Yeah, because we'll be dead.
yeah, that's what I mean. But I worry about, okay, let's bring it back to how hard, okay, is it going to be, it's going to be a landing. Is it going to be a nice, smooth, like 3-point landing? Is it going to be a little bumpy, or is it going to be, one that you hope to walk away from right now?
Well,
I don't walk away from
I don't know. Let me just say this. I will be stunned if we don't have a recession in 23. Don't know the timing, but certainly by the end of 23. I will not be surprised if it's not larger than the so-called average garden variety. And I don't rule out, not my forecast, but I don't rule out something really bad. Why? Because if you look at the liquidity situation that has driven this, we're going to go from all this QE to QT. We're following an asset bubble. We've been doing all this running down on the SPR, which is now, that's the Strategic Petroleum Reserve. It's now below 84 levels, even though obviously oil consumption is much higher. We've had a bunch of myopic policies that have actually delayed the liquidity shrinkage. QT has been almost entirely offset by Janet Yellen running down the Treasury savings account. By the way, pretty amazing policy. She could have sold 10 years for under 1% during this time. Instead, she runs down the Treasury savings account. So all that has masked the liquidity shrinkage, but it really comes into full gear. And she can continue this for a while. We can do the SPR for a while, stimulative stuff, but by the first quarter of 23,